You're listening to the Scotiabank Market Points podcast. I'm your host, Greg White. Market Points is part of the Knowledge Capital series, a collection of audio, video, and written commentary from Scotiabank Global Banking and Markets leaders designed to provide you with timely insights and analysis. Equity markets stormed back despite very frightening economic numbers. How has the Canadian dollar behaved alongside this market optimism? And with continued fiscal and monetary stimulus, fears of inflation have re-emerged. Meanwhile, incoming Bank of Canada Governor Tiff Macklem has not ruled out negative interest rates. On today's episode of Market Points, Shaun Osborne, Managing Director and Chief Currency Strategist at Scotiabank, shares his expectations for the Canadian dollar and explains why inflationary fears may be overblown. Hi, Shaun. Thanks for being on the podcast today.
Hi, Greg. It's good to be here again.
Shaun, the equity markets have been on a roller coaster ride for the past couple of months. How has the Canadian dollar behaved alongside that volatility? Has it been behaving the way you expect it to?
I think to a large extent, yes. I mean, effectively, it's been pulled along on the same roller coaster ride tracks as equity markets. To a large extent, the Canadian dollar weakened initially in the early part of this year as the coronavirus hit the global economy. Equity markets tanked, commodity prices fell, and that weakened the Canadian dollar. But since late March, we've had a very significant rebound in equity markets, generally speaking. Particularly in the US, we have the NASDAQ index, which is trading now slightly up on the year, which all things considered is a quite stupendous achievement. And the Canadian dollar has been reassured or stabilized by that rebound in risk assets. Generally speaking, the Canadian dollar tracks risk assets quite closely. As we will call a high beta currency, it tends to reflect the global growth environment, the global risk environment, whether investors are bullish or bearish on equities. These kind of things do have an impact on the Canadian dollar's performance on a day-to-day kind of perspective. And we have seen the Canadian dollar recover as equity markets have rebounded strongly since late March. Another positive impact on the Canadian dollar has been the declining volatility that has resulted from the rebound in equity markets. And we can see that measured volatility in the exchange rate, in the Canadian dollar exchange rate, has slipped back as well. So perhaps I think last time we were talking, we were mentioning maybe dollar Canada trading in a tight range or trading in the range around 140, somewhere between 135 on the downside, 145 on the upper end of that range. We've actually seen the Canadian dollar trade relatively strongly over the past couple of weeks as equity markets have extended that rise. But the volatility has also declined somewhat. So we're looking effectively still at a range trade in the Canadian dollar, I think, but the downside may be 138.50, the top side of that range, perhaps in the short run here, something more like 142.50.
I mean, in the context of this connection, do you feel this market optimism is warranted?
I think, well, it's difficult to say at this point, because I think what we're seeing is markets effectively look through some of the poor economic data we've had over the last little while and price in the expected sharp recovery in the second half of this year. So equity markets seem to be pricing for that sort of V-shaped recovery.
With all this strange uncertainty, if you're running a Canadian business that has a lot of risk exposure on the currency side, how are you implementing a hedging strategy in this environment right now?
Yeah, it's very difficult. Not least because of the volatility, but B, also because of the lack of visibility about just where your businesses are likely to be, or your markets, if you're an exporter, for example, where those businesses and markets are likely to be 3, 6, 12 months down the road. Everyone's assuming at this point, I think, that we will see a fairly rapid rebound in growth. That's certainly our base case. But I think the longer we remain in this lockdown environment, perhaps the longer the recovery may take, and I guess it's about trying to characterize the sort of recovery and the shape of the recovery that businesses expect, and with that lack of visibility about just where we're going to be in 3 months, 6 months, 12 months time, it is very hard for businesses to know what to hedge, how to hedge their currency exposure, and what sort of commitment to that hedge they should have. Normally, in a steadier economic environment, businesses will probably hedge fairly aggressively 3 months out, a little bit less so 6 months out, and just take on a modest hedge over a 12-month view. With the lack of visibility I think we have regarding economic prospects and just where we're going to be a short way ahead, I think businesses are likely to remain very conservative in their hedging approach in the next few months, at least until we get some visibility on the global economy and just how quickly this rebound is going to pan out.
The Bank of Canada is certainly keeping its options open with respect to being able to assist in economic recovery. And recently, of course, said that they wouldn't rule out negative interest rates. How likely is that scenario in Canada?
Unlikely, I think, but perhaps a little bit of context around those comments first, Greg. I think the headlines emerged on negative interest rates around the press conference that introduced or reintroduced Tiff Macklem to Canadian markets as the Bank of Canada governor designate to replace Governor Paulos when he steps down in early June. Mr. Macklem was asked by a reporter about negative interest rates, and like any good central banker, he effectively said, well, it's something in the toolkit, something that we could use. We wouldn't rule it out. And I think markets probably paid a little bit too much attention to the kind of headlines that generated, because in effect, Mr. Macklem was not saying anything different, I don't think, to what Governor Paulos has said already. They seem to be effectively on the same page about this in terms of a sort of fuller examination of Mr. Macklem's remarks, which was effectively, yes, this is something that we could do. It's probably not likely, however, and interest rates at 0.25 for the overnight target rate for the Bank of Canada is effectively the zero lower bound. So Mr. Macklem's comments really did echo, I think, quite strongly the views that Governor Paulos has previously outlined with regard to negative interest rates. And I think we should take those comments at face value. Are negative interest rates possible? Yes, certainly possible. Are they likely? I think highly unlikely at this point. I think there's other policy options that the Bank of Canada has at its disposal that it would pursue before it thought about implementing negative interest rates. And I think a key consideration for Canada is that it's probably not a policy option that they would pursue in isolation. We'd probably have to see, in other words, the Federal Reserve go the same way. That's to say, implement negative interest rates before we saw negative interest rates emerge in Canada. And everything we're seeing from the Fed's leadership particularly over the past few days, where it's come up as a topic in the US, is that this is not a policy choice that they are particularly favorably disposed to. Yes, I think it's possible. Is it likely? I think probably not at this point. Never say never, obviously, but there are considerations that I think make negative interest rates for Canada and the US not a particularly attractive policy option. Just very briefly, for example, negative interest rates can complicate the functioning of money markets. It can compromise the profitability of the banking sector, which has effectively the opposite impact of what negative interest rates are intending to do, which is encouraging lending. If bank profitability is compromised, then banks would probably tend to lend less. So that's clearly not an outcome that you would necessarily want. And I think just very briefly, the jury is still out on the effectiveness of negative interest rates on stimulating growth and lending in the economies where we've seen this introduced. It's not entirely clear that it's had a significant positive impact on lifting inflation or boosting growth. So I think considering those options and those factors, it's highly unlikely at this point that we would see negative interest rates in Canada.
Would there be, if the Bank of Canada did have to implement something like that, would there be an immediate impact on the Canadian dollar?
I think if you look around the world at banks that have pursued negative interest rates, there is certainly a sort of currency aspect of that policy choice. The countries that kind of spring to mind where negative interest rates have been implemented over the last few years, that would be Switzerland, Denmark, in the Eurozone, in Japan. I think there is a kind of common thread running through negative interest rates for those economies, that trying to control appreciation of the currency, certainly for Switzerland, certainly for Denmark, to some extent Japan as well. Controlling currency appreciation was very much a consideration in the choice to go the negative rate route. So although the stimulus effect of negative interest rates, I think, can be debated, I think the currency impact, or the impact on the currency from negative interest rates, is probably less debatable. And all else being equal, I would imagine that negative interest rates, if they were implemented in Canada, on the face of it, we would consider that a negative. But considering what I said a moment or so ago about the likelihood of negative interest rates, it's highly unlikely, I think, that we would go that route in Canada without the Federal Reserve in the US having gone that route before us. The net impact, assuming both countries go that route, both central banks go that route, the net impact effectively on the Canadian dollar may be relatively limited.
There's a lot of stimulus happening, and it's creating worries about inflation. Are you concerned about inflation at all?
Yeah, I think with all the stimulus that we're seeing being pushed into the system at the moment, we're talking about massive amounts of fiscal stimulus and balance sheet expansion by central banks around the world. There is concern that very easy fiscal and monetary policy is possibly going to lead to a spike in inflation down the road. It's not, in our view, at the moment at all likely. I think we have to keep in mind that inflation generally, very basically, is a reflection of too much money chasing too little supply. And certainly globally at the moment, we're not looking at the situation where there are those kinds of imbalances. If anything, with unemployment in Canada and the US in the high teens or 20%, consumer confidence taking a massive hit in this virus episode, there is not likely to be that kind of demand push on inflation. I think we have to consider also more generally that there is still a lot of excess supply in the global economy that has kept a lid on prices pretty consistently over the last few years. This was a concern, for example, after the 2007-2008 financial crisis, when the Federal Reserve sort of first embarked on this unorthodox monetary policy measure, quantitative easing, that investors were again concerned that inflation could be a consequence of this policy choice, and we haven't seen inflation emerge at all in any significant form globally over the last 10 or 12 years, and I think it's likely to remain the case. Of course, we have to think that we're talking about inflation in the sense of measured inflation, the traditional sense of the consumer price index and that kind of thing. I would say that a sort of secondary consideration is that we are seeing a degree of inflation in financial assets, in house prices, that we could perhaps tie back to this kind of monetary expansion. And it could perhaps be argued that conditions, these central bank stimulus, effectively are driving financial assets and house prices higher and higher. That's generally, I would say, if you're a homeowner or if you have any kind of equity portfolio, that's less of a concern because you're seeing the underlying value, of course, of those assets appreciate. So at the margin, perhaps we are seeing some sort of inflationary pressures emerge in certain asset classes, but not in the traditional, I would say, measures of inflation that we would perhaps be more concerned about in terms of general price inflation, cost of living, that kind of thing.
On the consumer side, then, has it been technological advancement that's been keeping inflation at bay over the last decade?
Yeah, I think there's a number of factors that have generally helped keep a lid on prices generally over the last couple of decades, effectively. Technology, as Governor Pollers terms it, the fourth industrial revolution, the efficiencies that new technologies continue to deliver, the fact that we are still effectively, I think, dealing with a significant global supply shock from that, and the emergence of China perhaps as a significant source of relatively cheap goods to the global economy. Those things combined, I think, have had a significant dampening effect on inflationary pressures generally over the last few years.
Tremendous number of factors then to be considering, and I'm sure it's a very difficult thing to do in this environment, but perhaps share your forecast for the Canadian dollar this year.
So we think essentially we'll continue to trade in something of a range around this 140 point for the Canadian dollar over the next few weeks and into the middle of the year. We are assuming that as we get into the second half of the year, we hopefully will start to see some tentative moves towards economic normalization, return to work. As I said earlier, I think the hopes for that coming fairly quickly in the second half of the year. Perhaps risk being disappointed, we may see that push back a little bit later into the second half. So I think for currencies generally over the next few months, it's likely to be the shape of the recovery globally that dictates the sort of net winners and losers in this environment. Whether we get the V-shaped rebound, the sort of U-shaped rebound, the Nike swoosh sort of shaped rebound, or hopefully not, but the risk of a W sort of rebound where we see a recovery, but run into perhaps a renewed outbreak of the coronavirus later in the year, which slows things down again. They're the kind of considerations I think that effectively will dictate which currencies do well, relatively speaking, over the next few months. Generally speaking, assuming that we're kind of in the ballpark of a fairly decent rebound in global economic activity in the second half of the year, we expect the Canadian dollar to pick up a little bit of support, not greatly so, and probably trade down to the 139 area at the end of this year. We expect a bit more Canadian dollar strength and a bit more general US dollar weakness actually to emerge in 2021. At that point, we expect the dollar Canada exchange rate should be trading somewhere closer to the 130 point. Our year-end forecast at the moment is 132. We assume alongside that we will see a bit of a rebound in crude oil prices, commodity prices generally as the global economy picks up.
That was Shaun Osborne, Managing Director and Chief Currency Strategist at Scotiabank. You can find more thought-leading content from Scotiabank on our website at gbm.scotiabank.com, and you can also follow us on Twitter at ScotiabankGBM, as well as our LinkedIn showcase page under Scotiabank Global Banking and Markets. Please refer to our legal disclosures on our website. Thanks for listening.